Welcome to this explainer. If you've ever found yourself wondering exactly how the pros maximize their wealth while somehow keeping their anxiety in check, well, you are absolutely in the right place today. We're going on a bit of a journey to demystify modern portfolio theory. We're going to break down the literal building blocks of risk and return and see exactly how they stack together to form the ultimate investment strategy. All right, let's just dive right into it. Here's our roadmap for today. We're going to cover 1. The history of risk and return. 2. Understanding risk aversion. 3. The math of portfolios. 4. The power of diversification. 5. The efficient frontier. And 6. Finding your optimal portfolio. It really all boils down to this fundamental question, doesn't it? How do you actually build the perfect investment portfolio? It's the one thing every investor wants answered, for sure. I mean, is it just about picking the absolute best performing stocks? Or is there a deeper structural science behind the whole shebang? Let's find out. Section 1. History of Risk and Return. A Century of Markets. Now, before we start throwing numbers around, we've got to make a really crucial distinction between historical return and expected return. Historical return is just what was actually earned in the past. Simple enough. But expected return, that's what an investor anticipates earning in the future. To get you to part with your hard-earned cash today, that expected return has to compensate you for the real risk-free interest rate, expected inflation, and the specific risk premium of the asset itself. Look at this data spanning from 1926 to 2017. The historical risk-return trade-off is just perfectly illustrated here. Small company stocks generated a pretty impressive 12.1% annual return, but notice that massive risk tagging along, a staggering 31.7% annualized volatility. Now, large company stocks gave us a 10.2% return for a lower 19.8% risk. And down at the bottom, Treasury bills are sitting there with a tiny 3.1% volatility. Over the long haul, the market historically rewards higher risk with higher returns. But to successfully navigate that risk, we really have to understand the human mind. Which brings us to Section 2, Risk Aversion, the human element. Let's try a quick thought experiment to ground this abstract idea of utility theory into a relatable human decision. Picture this. You're offered 2 choices. Option 1, you can take a guaranteed 50 pounds right now. Or option 2, you take a gamble. You get a 50% chance of winning 100 pounds and a 50% chance of walking away with absolutely nothing. So, what are you going to choose? The mathematical expected value in both scenarios is exactly 50 pounds. But a risk-averse investor, they're almost always going to rank the guaranteed outcome higher than the uncertain one. The utility, which is basically just the measure of relative satisfaction or happiness you get from the money, is higher for the guaranteed cash precisely because it completely lacks the anxiety of the gamble. How do we actually measure that anxiety, though? Well, we use something called the risk aversion coefficient, represented by the letter A. It measures the marginal reward that an investor requires to accept additional risk. If you're a highly risk-averse person, you've got a high A value. That means you need massive potential returns to stomach even a tiny bit of extra volatility. On the flip side, a totally risk-neutral investor has an A of exactly 0. All right, Section 3, the math of portfolios, combining assets. Here is where the math throws us a total curveball. You'd probably think the total risk of a portfolio is just the weighted average of the risks of the individual assets inside it, right? But it's actually not. Total risk depends heavily on covariance, which is how the assets interact, and correlation. Correlation is simply a bounded statistical measure of exactly how 2 assets' returns move in relation to each other. Think about it like this. If the correlation between your assets is exactly +1, it means they are moving in perfect lockstep. And if they move in perfect lockstep, you get 0 reduction in risk. Absolutely no diversification benefit whatsoever. This really drives home the absolute necessity of finding non-correlated assets. You need assets that zig when the others zag. Section 4, the power of diversification, risk reduction in action. This right here brilliantly captures the magic. Over on the right side, individual stocks like Li & Fung and Costco Pacific have really high standard deviations, which means high risk. But check out that lighter diamond-labeled equally weighted portfolio. By simply combining these specific assets together, the overall risk is physically pulled to the left. The portfolio itself has a substantially lower overall risk than holding those individual securities on their own. It's wild. Diversification isn't just some nice theory. It is a measurable, mathematical risk reduction tool. Moving on to Section 5, the efficient frontier, optimizing the universe. When we take all those possible asset combinations and map them out, we get the Markowitz efficient frontier. Rational, risk-averse investors are always looking to minimize risk for any given level of return. Because of that, they'll strictly focus on the boundary of portfolios that curve above the global minimum variance point. Anything sitting inside or below that curve, it's inefficient. You could get the exact same return for less risk just by moving your investments up to the edge of the frontier. Let's unpack this curve a bit. It starts down at the global minimum variance portfolio, which is the absolute lowest risk combination possible. Then it moves up and to the right, showing that you've got to take on more risk to get more return. But here is the kicker. The slope continuously decreases. That means as you keep pushing to the right, taking on more and more risk, yields decreasingly smaller bumps in return. It's essentially the law of diminishing returns applied to risk-taking. And finally, Section 6, your optimal portfolio, the final building block. So, how does this actually help us build the ultimate strategy? Well, if we introduce a risk-free asset, something like treasury bills, we can draw a straight line directly from the risk-free rate on the y-axis outward. This is the Capital Allocation Line, or the CAL. It reveals all the new investment possibilities that open up when you combine a totally risk-free asset with a portfolio of risky ones. Now, watch what happens when we lay that capital allocation line right over the efficient frontier. The most dominant superior line is the one sitting highest on the graph. That line perfectly touches the efficient frontier at exactly one single spot, point P. That exact point of tangency, that is your optimal risky portfolio. It completely dominates all the other possible combinations on the frontier because it's giving you the absolute best risk-to-return ratio mathematically possible. This whole process is actually codified into something called the two-fund separation theorem, which lays out exactly how you should allocate your wealth in two logical steps. Step 1 is purely mathematical. You find that optimal risky portfolio, that perfect point P we were just looking at. Step 2 is where we bring your personal psychology back into the mix. You overlay your own personal indifference curve, which is based on your unique risk-aversion coefficient, to figure out your exact mix. Essentially, how much of your money sits safe and sound in the risk-free asset, and how much gets deployed into that optimal risky portfolio. Which leaves us with one final, pretty massive question for you to ponder. We know the math now, right? And we know how the market optimally combines assets. But where does your personal indifference curve intersect the capital allocation line? Honestly, assessing your own personal risk tolerance is the final vital step to taking these building blocks and applying them to your own wealth. Thanks so much for hanging out with me on this explainer. I really hope you're walking away looking at the foundation of your portfolio in a completely new light.